Hello. In this video, I wanted to give you an example of what I'm expecting you to include in your presentation and discussions for the funding negotiations. Generally speaking, there's not much more you need to do in terms of calculations. This is really about making sure that you have the information that you need. So I'm showing you a presentation, and then I'll kind of talk to you about how you can get some of the stuff that's in it. So in the presentation, you want your business concept. You can use the same description you've been using. You want key assumptions. Under this, instead of going through, all of the assumptions you have for revenue and costs that you've gone through so far, this is where we would want to focus in on having done a sensitivity analysis and really identified those assumptions that have the most material impact, and then doing some scenario analysis so that you can communicate the bad case, likely case, and good case values of those assumptions. Then you're going to provide me with some forecasts. So whereas in the sensitivity analysis, we really just focused on present value and the minimum cash balance, here what I want to do is to provide a sort of compare between likely versus these other scenarios of the operating cash flows and the cash balances, so that as an investor you can kind of get a sense of how all that's working. So you'll do those, likely versus bad. At the end of that, you'll have some possible mitigations. I'll explain that when we get to it. At the end of the good, you'll have possible opportunities. And then the last slide should be your funding proposal, what it is that you're asking for. So the idea is you should come in prepared to make an ask. So again, business concept, same thing it's always been. Sensitivity analysis, I just took these straight from the prior risk analysis that we did. What you would want to do is focus on what really constitute the key drivers and the fact that really, much of everything else just didn't seem to be a big impact. And so, that's what I did. You're using your same scenarios, likely, bad, and good. So you can just use that same slide. The key to that, and again, you want to spend a little bit of time talking to them about the logic for why one is bad. And, if we start at 300 likely, why 250 is really considered bad, and it couldn't get much worse than that in sort of a realistic scenario in the short term at least. And 350 probably realistic on the other end, because obviously, for staff, same thing for students. The number of student customers per day, again, sort of bounded. Anyway, you want to talk about why those seem like, whatever your assumptions are, why those seem reasonable with the potential investor, so that they can understand, were you being very optimistic in your bad assessment and it really could get quite a bit worse with some material likelihood, or were you being pretty pessimistic in that assessment, as an example. Same thing with the good side. And it is important to go ahead and talk about these values and the fact that, quite frankly, there's a very wide range here with a fairly low risk that you're going to wind up with just a negative outcome. Negative meaning that you're going to ultimately ask for about a $1.4 million investment, and you're going to have a project that undershoots on a present value basis the ability to pay back that investment by about $1 million, meaning it could pay back about the first 400,000, but it couldn't pay back the rest of it. Okay. So from there, now we want to start looking at our results. So we're looking at likely versus bad. First, the operating cash flows for year one. And you'll want to think about, what's going on there. For example, in the bad scenario, operating cash flows, at the very beginning are almost 1.4 instead of a little over 1.2. What's driving that in month 0 is primarily that that we assumed that we were going to have to spend an extra $200,000 on the building. So you want to make sure that you can explain what's going on with that. Then when you go to the year 2 through 10, you can see that in the likely case, we're looking at cash flows even by year 2 that are, cash balances, OCF, so cash flows, that are like 360 a year and grow up to over 400 a year, versus in the bad case, 88 a year and really only growing to 98 a year. So again, interestingly, we're not projecting that the operating cash flows are going to go negative. However, they're just not going to be big enough. If you thought about how much you were borrowing and the interest and all that, the cost that the equity return wants and everything, just not big enough to really pay everything back. So the OCFs don't go negative. Again, they just aren't enough to pay back all of the investment. Now, if we look at the cash balances, and keep in mind these are operating cash balances, they don't include the balance, the amount that goes back to the investor. Again, if we look at most likely in year 1, you're already up to a $250,000 plus cash balance by the end of year 1, and if you looked at the bad case, it's really only about 55. So pretty big difference. Obviously, that 200,000 is largely driven at this point, that sort of initial, by the fact that you had this bigger cash outlay. That's part of the reason why you're asking for so much cash as investment, is you want to make sure that if you need it in order to spend more on the building, that you'll have it, and you'll still have enough cash to basically run the business. All right. Now, in years 2 through 10, again, under the likely scenario, kind of grows from about $500,000 to $3.5 million. Once again, these cash balances have not yet considered that I need to pay back, the interest and the principal on the debt that I take out, plus have some left for equity. But I think you can see that there's quite a bit of cash there, and so certainly available to start making those payments. Whereas in the bad case, the problem that we get to is if we were to just accumulate all the cash over time, we wind up at the end of year 10 with only $900,000, and we have not paid our $1.4 million back yet. And so that's fundamentally the issue here, is that we just do not generate enough cash to ultimately pay everything, the investors back. So again, not running a loss. This is sort of that key aspect of not focusing on profits. We're not running a loss here. We just simply aren't making enough to also pay our investors back. Now, what are the mitigations that we could do with that? As far as the customer, campus customers and spending, sort of those revenue factors, unfortunately, that's somewhat out of our control. We could maybe try to attract a larger percent of those on campus, or possibly do more deliveries to try and get the total amount up, and so rely less on people walking over or driving over to the location and more on us going to them. But honestly, this is our big risk factor, is whether or not the campus customers are going to have uptake or not. Variable costs, one of the assumptions is that our variable costs go up well above our budgets. These are more under our control. Obviously, if we have fewer customers, then we should be able to do a better job of managing our labor and our food costs, and basically trying to keep those in line. So I would say, sorry, I got to fix this. It's just the way I am. I would say that of everything that we assumed in the bad scenario, this is probably one of those that is very controllable, and we should be able to try and avoid the scenario, that aspect of the scenario. Indirect labor, again, since indirect labor is not really tied to sales, and there is a certain amount of money we have to pay our management in order for them to be willing to manage, there's not much we can do. If the sales are low, the labor stays, the indirect stays rather high, there's not much that we can do there. However, we could potentially convert the the management salaries to having a larger portion of it tied to bonuses that are maybe driven off of operating cash flows or revenues or whatever. The idea behind that is that on the one hand, you're incenting the management to get even more to go out and try and drive sales for you. And similarly, if they're unable to, then it reduces the actual amount that you spend on indirect labor a little bit. It's just a thought. We would have to evaluate that if that situation came. The last thing is probably on the investments. Again, the assumption was that we would go from 1.1 million to 1.2 million in terms of the purchase of the land in the building. And we could just simply put a budget on that and say, we're not going to go over that. And so as long as we don't go over that, if that's an important thing and an important risk mitigation, then we can just plug that as a cap. Now, the idea would be if we can't find a building that's suitable, land and building within that price range, then we just have no project at all. And that would be the point where we would probably give back the bulk of the funding. So that could be a big mitigation, so that rather than us winding up with a $900,000 loss, we might wind up with a $20,000 or $30,000 loss going forward, simply because it does take a little bit of time and money to get to the point where you either know or don't know whether you have that land and building. So then the next thing that you guys would want to talk about would be your good scenarios, and obviously in the good scenarios you can kind of point out the good things and what's driving them, just like we did before. Clearly, our operating cash flows are a little bit less in this one. I'm not quite sure why they're where they are. I guess that's the equipment is that high no matter what. I'm not sure. Sorry, what's driving that? Obviously, though, over the 2 to 10 year period, quite high operating cash flows in years 2 through 10. More than double what they were under the likely scenario, and so quite positive there. Suggests that things are going quite well. Here's the thing that you probably most care about at this point. Clearly, your cash is growing much quicker. You're already have $300,000 balance right at the beginning. I guess partly because you were able to avoid some of the investment costs, and clearly have quite a bit more each year after that, or each month after that in year one, more than you really need, and obviously have a huge amount of cash build up, even more than under the likely scenario. I mean, in the likely scenario, you get to $3.5 million by the end of year 10. In the good scenario, you're in that range by year 4. And so a big build up relatively quickly in cash. So if that scenario were to start to unfold, we see that as creating some additional upside opportunities that we don't have reflected in the model. So for example, if we see an acceptance level, meaning the percentage of campus customers or potential customers that come in of 50% a day, that's pretty strong validation of our concept. And so we could start thinking very quickly, if we start seeing those results, say in year 1, about targeting other campuses and facilities. And so we could take the cash that's building up in that and use it to expand. If the variable costs are maintained at the level that we're talking about and we're still getting a 50% acceptance, that's obviously great news. Means that we've got a strong control process for our labor and our costs. And so we want to make sure that whatever it is we're doing with that we sort of codify that, institutionalize it into our organization, so that if we do open new locations, that we can use those same processes to keep our costs at that level there. Indirect labor, obviously, because that's sort of stable, even though the business is going crazy, that's what keeps drives the percentage down. No need to change that unless you want to start introducing maybe just a little bit of a bonus structure there, or a little bit of an additional one possibly. Clearly you have the room to do that, and we can't underestimate the importance of good management in making the business a success. Lastly, really the investments. If we are able to secure land and building at the reduced amount, then that changes our cash situation. And if we're able to do that and also get good results, then within the first 3 or 4, 6 months, let's say, we may find that we already have much more cash than we need, which leaves us with some choices. One, we could use it to pay down the debt more quickly. So, for example, if I'm sitting there with $400,000 or $500,000 worth, if you look at the cash balances, you're already looking at having $600,000 or $700,000 in cash balances by month 9 under that scenario. If that's the case, then you might use that and just go ahead and pay down the debt more quickly. That will reduce your interest expenses, obviously, and significantly reduce the risk going forward. Or 2, you could use that cash to start looking for a second location. Or 3, you could just distribute that to the equity partners. Now ponder that one for just a second when you see what we're asking for in terms of funding, that there is a scenario here where we could be distributing a substantial amount of cash back to the equity partners in less than a year. So, given all of that, here's what we have developed in terms of sort of what we would like to see as a funding proposal. We would like to see we're looking at $1.4 million total that we need to raise. We'd like to see $100,000 of that, or $1 million of that, come from debt, and $400,000 from equity. On the debt, we would hope to have a 10-year note, and so we'd be paid off at the end of 10 years. We would expect that to be an amortized debt, so we're paying fixed payments every year with principal and interest combined into those, secured by the land, building, and equipment. And because of that, because the land, building, and equipment themselves are valued at significantly more than $1 million, and you have this amortized structure, we would expect to get a rate that's more or less in line with sort of the commercial and real estate rates, because effectively we'd be using most of this to buy the building. And so anyway, at that point, that's kind of what we would expect, about a 6% annual rate. Assuming that we can achieve that, then we would want the $400,000 to come in the form of equity. These would be common shares with voting rights. They're not preferred. We would give up a 9% stake in the business to the equity investor that provides that, which means that we as the developers would hold the remaining 91% equity. Okay? Now, you as a student could possibly be saying, well, how did I come up with this, right? Particularly the equity side. The interest side just is what it is. So remember back from the discussion about cost of capital, how we modified your spreadsheet in order to have these sorts of inputs. The way I came up with this is I put in total financing $1.4 million, right, which is just reading off of what was already in the model. And it's important that you make sure that you've got this back to the scenarios that you wanted in. So go to Scenario Manager, make sure you have likely selected, hit show and close so that everything's calculated based on the likely scenario. And you can calculate on the other ones if you want, but that's how I do it. So with the likely scenario, 1.4 million, million of it in debt, that's what we asked for, 6%. It kind of calculates everything else out, as you will see from the video related to this separately, right? That's part of the module discussions. That implies you're going to need $400,000 in equity. That's its weight. And the question really becomes, what do you want in terms of your cost of equity, right? And so this works it a little bit different than what we were doing in the exercise related to the modules, where we're solving for the cost of equity. Here, you put in the cost of equity that you're sort of looking for reasonably. And, everybody can decide their own, obviously. What I did was my best case, I'll just tell you, my best case scenario, I had hoped for a cost of capital of about 8%. And so what I did was just start playing around with the cost of equity. I tried 19%. It came a little, that calculated to a weighted average cost of capital. It was a little too high. So I dropped it down to 18.5. That was a little bit too high, so I dropped it down to 18, right? So I'm looking for something that will get my cost of capital where I want it, all right, which is somewhere around the 8% range. And you could actually solve for that if you wanted to. So you could do a what-if analysis that says goal seek, set, sell, whack to 0.08 by changing your cost of equity. So when I did that, it comes out and says, okay, there you go. Oh, sorry, it won't do that. My apologies. It won't do that. It doesn't like that because you need to have values, I guess. I don't know exactly why it didn't do that. Anyway, I can try that again. Let's see if maybe I just did something wrong. What if? Goal seek, set that cell equal to 0.08 by changing cell cost of equity. Say okay. I'm not sure what I'm doing here. Set cell. Okay, somehow I'm just getting that messed up. There we go. Not sure what's going on there because it's not changing this. Anyway, so that's, for some reason, that's not working. But I could play around with it. I could do like a 18.1%. You'll see that moves it up. 18.2% moves it up. So somewhere around 18.2% would be sort of the cost of equity. Well, that's only the first step, right? So I have a whack in mind that I'm trying to achieve. So I move my cost of equity to that. Well, now we have to go figure out what would the share of the business be that would basically make sense. So it would cause the present value of the business to be equal to, of the share, to be equal to $400,000 in order to make all of this make sense. And so here we can go in, again, this time we're using the goal seek again, and we're saying we want to set cell B106 to 0, right, by changing the share of the business. Hit OK, it's going to change that. I don't know exactly what it changed it to, but some small decimal change. So 9.26%, call it, 27%. So 9.25%. So if I wanted to be that generous, I could do that. I'm going to go back down to 18% where I was. We're going to do this same thing again. So data, what if analysis, goal seek, set the difference equal to 0 by changing the share of the business. Okay, 9.16%. So again, you can kind of play around with that, but I just came out and said 9%. So that's how I got to the 9%, was basically by going through this process and saying giving them a 9% stake in the business, assuming that the debt is what it is, and we get it 6%, and the equity is the amount that we want, would get me to somewhere around that 8% cost of capital. Where do I keep coming up with that 8%? That was my best case scenario, was good case, we can get a cost of capital of 8%, okay? My likely was 15%, and so, that's kind of the thing where I would start, if they started moving me towards something, I'd have to draw a line and say, at what point do I not want to move anymore, right? At what point am I not comfortable with where I'm at, I guess, that I don't want to give up more than that. And so in that case, what you're doing there is basically moving the share of the business, right? And so you have to start thinking in terms of, oh, that is somehow some percentage change in the cost of equity, right? So we would start out again by saying, okay, how much would we have to change the cost of equity in order to make this 15%? Well, let's just go to 30. See, 40. 45. Let's call it 43. That's pretty close. So you're talking about giving somebody a 43% return on equity, assuming you get the 6% financing on the debt. Talking about giving them a 43% return on equity. That's just ridiculous. All right, that's a big return unless it's a really risky project. Not sure I would give that up. But if you had to figure out what that implied in terms of share, think about it this way. So again, we've got to set this difference equal to 0 by changing the share. Okay, it means we would give up about 32%. So now what you know is you're starting at 9%. You probably don't want to go any more than 32% share in the business. And in my case, I might go below that. So now you have this choice left in your negotiations. If you can't secure the funding, you don't get to do the project at all. And so you now own 100% interest in nothing, right? If you do secure the funding, then, even at this rate, possible return to the investor, right? You now own call it 68% stake in something. And so sometimes that really becomes the thought process for you is, I hate giving them that kind of a return, but if that's what they have to have or they're walking away, I'm almost better off doing that than I am getting 100% of nothing, right? And so that's really the discussion here. Anyway, I know this was a little bit confused, so I am fully expecting that this is the kind of thing that you're gonna have questions in class about, but I did want to kind of show you how to use the tools that we've been discussing in class to support you in this negotiation. I hope this is helpful and not too convoluted. As always, come to class with questions.